Hello, everyone, and welcome back to another episode of Planning for Retirement. I'm your host, Scott Nelson. With me is Elyse Zares.
Hello.
What is on your mind today, Elyse?
Um, on my mind today would be market volatility. There's a lot of our clients that have called this year. They're just really nervous. They're watching the day to day on the markets. They don't have a whole lot of confidence right now in the markets. So I was wondering if there were key points or things to keep in mind when looking at those investments.
We have had our fair share of calls with all the volatility we've seen.
Which is very valid. It's been a roller coaster.
So human psychology is such that we tend to really remember losses, and they impact us much more than gains even. And with the market this year, what you have to keep in mind is to keep the long-term perspective. What do I mean by that? Well, first of all, you have to recognize that markets don't think, they just react. And if they're going to react, they're going to react negatively. Markets hate uncertainty. So as we're recording this, there are all kinds of talks about tariffs being enacted in another week or so. No one's really sure how that's all going to carry through. And so with the uncertainty, we see stock values drop a bit. So as we talk about keeping a long-term perspective, what we have to remember is in most cases, after the market has had a chance to actually see the reality of things after their fear, they usually come back and then some. And I think we're starting to see that a little bit with the tariff talks. They're starting to bounce back. But in the long term, markets have outperformed all other asset classes over time, but it's a bumpy ride.
So keep that long term frame of mind, meaning don't watch it every day.
I don't. Well, I kind of do because I have to, but in terms of looking at my own account balances, I don't. Just because I know that what goes down is going to come back up and then bring friends.
What's another way for you to help assure that your accounts are where they should be in a volatile market? So what's some other things that you can keep in mind?
Oh, there's several other things we can talk about. Let's first talk about diversification. So
What does that mean?
it means not having all your eggs in one basket. You've heard that expression.
But what if I do have all my money in the market?
Well,
Can you diversify that way?
yeah. So even within the market. So if you are investing in a single stock, that could be a big problem because there are things that can happen to an individual company that affect that particular company's stock that doesn't necessarily reflect the overall market dropping.
Right.
And so by investing in multiple places, you're diversified. And especially if those places are in different sectors of the economy. For example, you might have some of your funds invested in tech. You might have some of your funds invested in manufacturing. You might have some of your funds invested in consumer goods or consumer retail, financials, communications, commodities. So what do you mean by commodities? Steel, gold, silver, real estate, things like that. And all of those can be part of your portfolio. Now, that said, the market as a whole can still go downward if there's a pandemic, if there's a 9/11, if. But again, the market is consumer driven these days. And so as long as people are living their lives and doing their thing, these companies are going to sell their goods and they're going to be profitable and it'll bounce back eventually.
So
But
it sounds like a good thing to do would be to stay informed when these
well,
things are happening.
yeah.
Don't overreact, I guess would be.
Yeah, so if you're going into a market monitoring site and you're looking at charts and graphs, if you look at the intraday trading, it looks like it's all over the place, but really it's just a narrow band. But if you're looking in a short period of time, it looks terrible. Expand that out. Look at the last month, the last quarter, the last year, the last 5 to give yourself some perspective for the long-term view. Stay diversified. Another tool that is really good, and especially in a volatile market, is utilizing a tool called dollar cost averaging.
And what is that?
So dollar cost averaging is real simple. Those of you who are contributing to a 401k via payroll deduction, you may not have realized this, but you are dollar cost averaging. What that means is you're putting away a consistent amount of investment. You're investing on a regular basis, a consistent amount, and you're going to automatically have money go in during one of the market dips, and you're automatically going to catch prices on sale so that when the market recovers, it's a dramatic increase for you. So my wife did this right as the COVID thing hit. I mean, it was a dramatic drop, as everyone will recall. Right. And by golly, she had over a 50% return in that account by the end of the year. It was tremendous. So Warren Buffett calls himself a contrarian, meaning when everyone else is selling, he's buying, and when everyone else is buying, he's selling. You want to buy low and sell high. It's not complicated.
No.
So, simple concept. So if you're diversified and if you've got an emergency fund, so you don't have to pull money out when the market's down, if you have assessed your risk tolerance, and everyone's different in that regard, it's a very personal thing. So just like some people love the thrill of roller coasters and others hate it or they get motion sick by it, know what your risk tolerance is and invest accordingly. There are ways to invest
safely.
Yeah, in a reasonable way. Yeah. For example, you've heard the term large cap stocks. Yes. We're talking about ginormous companies, huge companies, and maybe their stock prices aren't necessarily rising a ton, but they pay dividends, so they've got their earnings that way. Or you've heard of mid caps. Those are the medium range companies, and small caps. As a general rule, we're going to see the smaller companies' stock price be more volatile than we're going to see the great big established companies because they're still on the growth curve. But you've got potential for greater gains in the smaller cap investments. So you can tailor a portfolio, and that's where a professional advisor can come to help you or study it out on your own. But, diversify. Have assets across a spectrum.
What are some things that you should avoid when looking at managing the market volatility? What are some things that you should avoid?
First, avoid panic. Okay, just because you heard it on the internet does not mean it's true.
I think that it helps knowing your risk tolerance. Like you mentioned, just knowing where you're at, what you can handle, and what makes you uncomfortable.
Yeah, and so
that would help a lot.
Yeah, so risk tolerance, yeah, definitely, because that's a personal thing. Then there's also risk capacity. So there may be someone who they can handle the risk emotionally, but they can't really afford it. So that has to do with how close are you to needing to get the money out? What's your time horizon? How much do you have in reserves elsewhere? That's a big factor. How steady is your other sources of income, things of that nature. Avoid panic. Um, Avoid emotional decision making. And we're emotional creatures. I understand that. And I know most decision making is basically based on emotion, and then we look for logic and facts to support the emotional decision we want to make. But if we can avoid making it strictly on emotion, I like it when things feel right, but I like it better when math backs it up. And so, if in doubt, get a second opinion from somebody that's not emotionally involved. And I really think that's where our office adds a lot of value for our clients is we can bring the long-term perspective. We can bring education and math to bear so that, maybe that's still a good decision. They want to do it, but let's make sure.
Yeah, we even have, a questionnaire to assess your risk tolerance. So even something as simple as that might help greatly in the long run. So.
And that said, so as we look forward, this is 2025. We're in early part of the year. We have all kinds of news every day. It's not just one new thing. It's a half a dozen new things that are threatening to disrupt. And what we're finding is those threats may just immediately vanish the next day. We see a lot of talk about tariffs and what that might do. Personally, I'm hoping that generates a lot of revenue to the Treasury and we get our deficit under control. We're seeing fuel costs come down. That should be deflationary. We don't know that there will be the giant impact everyone's fearing. We kind of have to wait and see. So if you're diversified, you've got your emergency fund, we have a long-term strategy, you're investing, not trading. Big difference. Traders are doing trades every day. They're in short positions. They're ready to get right back out. We don't think that way. We're investing for the long haul. History supports that as a very successful outlook and approach. That's what we want, are things that are tried and proven.
Yes, and it's important to stay informed. And if you would like, we do send out weekly emails that kind of touch on these different areas and concerns that people have. And so we do send out an email. You can contact us. We can get you on that email list just to have up-to-date information.
Yeah, we're happy to do anything we possibly can to be of help. If you have concerns about your portfolio, the direction things are going, or where you're at, we're always willing to provide a free second opinion. Our goal is to give people peace of mind about their finances and make sure things are set up the way they should be. If you find value in these podcasts, we would love it if you would share it with others. If you would like to consult with us, we'd be happy to invite you to our website to schedule a free consultation or call our office at 435-723-3370. Be happy to do what we can. The forecast for the remainder of the year is volatility. There are a lot of changes happening, particularly in the U.S., particularly having to do with trade policies and so on.
It's interesting.
We hope that those will all turn out in a positive way, but it's going to cause volatility in the journey. If you're concerned, let us know. We'd be happy to give you our second opinion.
Thanks, Scott.
Thank you. Always a pleasure.